5. Segregated fund and annuity recommendation. When the individual investor profile is complete, the time arrives for the agent to recommend the most appropriate segregated fund and annuity investment. The agent must weigh many factors in developing the recommendation and ensure the client investor understands the rationale underlying the choice or choices presented. Recommendations for groups are also prepared by the agent. This aspect of the agent's role is addressed later in this manual. The Canadian Council of Insurance Regulators, CCIR, and the Canadian Insurance Services Regulatory Organizations, CISRO, have set out guidance to address the fair treatment of customers. 29. It encompasses concepts such as ethical behavior, acting in good faith, and the prohibition of abusive practices. For agents, treating customers fairly means black small square developing, marketing and selling products in a way that puts clients' interests ahead of the interests of the agent, insurer and intermediaries. Black small square providing clients with accurate, clear and sufficient product promotional material before, during and after the points of sale that allows them to make informed decisions. Black small square providing information to clients during the lifetime of their contracts which allows them to make informed decisions. Black small square minimizing the risk of sales that are not appropriate to the client's needs. Black small square ensuring advice is relevant. Black small square dealing with client claims, complaints and disputes in a fair and timely manner. Black small square protecting the privacy of client information. Black small square avoiding or managing any conflict of interest that would affect the fair treatment of customers. The fair treatment of customers should be the objective of every agent. Agent actions should support the principles listed above and in the full guidance, which is available online. The recommendation for purchase may be presented as a single recommendation, or as a comparison between a primary recommendation and secondary choices, or as several options. Every recommendation will have pros and cons. These must be disclosed in the reason why letter that an agent prepares, and is an expectation for agents from both regulators and insurers. The agent must discuss the information in the letter with the client to help him understand the product recommendation and record it in his client notes. This ensures that the rationale behind the decision is available should the recommendation be questioned in the future. 5.1 Finding for a segregated fund. When the needs analysis is completed, as shown in Chapter 4, the agent may find a set of client characteristics that shows the best recommendation to bring forward is a segregated fund. For instance, the client wants an investment with the benefits of an insurance contract and the ability to tap into the performance of the capital market. His needs indicate a long-term investment is most suitable. He is not seeking income from this investment at this point in time, or for the minimum duration of a contract. The agent properly concludes that a segregated fund investment should be recommended. There may be other factors that lead the agent to conclude the segregated fund recommendation is most appropriate, such as the guarantees offered or the ability to bypass probate. He must analyze benefits and limitations in view of his client's needs and make a thorough comparison of funds suitable for those needs. 5.1.1 Fund Analysis. As shown in Chapter 2, the agent has a wide selection of funds from which to choose to develop his recommendation. He must be methodical and accurately analyze what is available to arrive at an option or options based on the client's investor profile. This involves staying up to date on new fund introductions and other similar developments through various industry channels. The agent should read industry journals and the marketing materials provided to him. He should also seek out the product wholesalers for their input. It is not adequate to rely on old standbys alone. The agent's analysis and subsequent recommendation should have nothing to do with the rate of commission or trailing fees offered by the fund. Client suitability is the only standard by which to judge whether a fund is a good match for client needs. Analysis should be based on current information, and it should be provided to the client in a timely fashion. Each insurer has information readily available on their funds, and the agent may choose to supplement these details with other research. Third-party sources of information, such as that gleaned from the Internet, must be considered very carefully. Sources must be verified as being accurate. The agent may wish to obtain approval from his compliance officer before presenting any of this type of information to the client. Information provided to the client can be fact-based and/or opinion-based. The agent should be clear with the client about which information is factual and which is his opinion. Every client is unique and presents an individual set of characteristics. An analysis coordinates these characteristics with fund details to arrive at a fund that is the best match. 5.1.2 Supporting the segregated fund recommendation. The agent must determine which factors of the product are of greatest importance to client needs based on the investor profile. Chapter 4 provides a thorough breakdown of those considerations. Segregated funds and annuities. Chapter 5 Segregated fund and annuity recommendation 166. The agent must be able to prioritize those needs, as well as the segregated fund features that fit those needs. For example, if the client is most concerned that he will lose capital invested, then the maturity guarantee should be at the top of the agent's features list for that client. The agent can show that full protection of capital is provided by some funds through a 100% guarantee. Moreover, outside Quebec, if the segregated fund is being acquired for estate planning purposes, then bypass of probate may be of greatest importance to the client. After prioritizing needs against features, the agent reiterates to the investor the characteristics of the fund that align with his objectives. The agent focuses on the primary benefits that make the recommendation a suitable choice and points out limitations. Other factors of lesser importance can rightly take a back seat in the recommendation. However, the client needs to see the whole picture in order to understand the choice or choices that are presented. 5.1.3 Making the recommendation. When a suitable recommendation is ready to discuss with the client, a meeting is required in which the agent can substantiate his findings and the client can ask questions and provide direction. Prior to the COVID-19 pandemic, such a meeting would typically be held in person. The agent brings his written documentation for discussion and a client sign-off would be completed with the agent present if an application is completed. During the pandemic, the in-person approach has been largely replaced with the online virtual meeting, phone meetings and electronic signatures. A virtual meeting, such as Zoom, needs planning and organization to be successful. It starts with both parties being able to manage the technology to log in, enter a password, access supporting documents, provide an electronic signature when necessary, and log out. The internet connection must be good enough to support the meeting without pauses and disconnecting. Some people do not have the necessary computer skills, and the agent will be required to send documents by courier and complete the discussion with the client over the phone. This can put the agent at a disadvantage because he is unable to read the visual cues the client might show, like nodding in agreement or shaking his head in disagreement. An agent may find that a hybrid approach is best, sending physical documents and meeting virtually to discuss what was sent. Clients who are willing to receive documents online should be provided with them prior to the virtual meeting to ensure the documents are received, and better yet, reviewed before the meeting. There is considerable etiquette to be followed for a virtual meeting. Agents should research the rules before they embark on meeting virtually. When the client needs to issue payment, this is now best accomplished by an electronic transfer from the investor's account to the account you specify to receive the funds. Problems can arise when the amount of payment exceeds his daily transfer limit, or he may lack the wherewithal or confidence to make the payment electronically. In such a case, a check is issued for which you should send a courier for pickup. You do not want to force the investor into going to a post office and transacting with employees and other customers to mail or courier the check. The need to meet virtually eliminates the physical signature on documents. Electronic signatures, e-signatures, are now the order of the day. An electronic signature can be provided in a number of ways, including black small square, a physically signed document that is then scanned and transmitted. Black small square, a scanned signature pasted into an electronic document. Black small square, a typed name. Black small square, a signature created using a stylus or finger on a touch screen. Black small square, clicking an electronic confirmation. Some people are reluctant to use such electronic formats, fearing that their signature could be copied and used elsewhere, or that the document could be modified after signing. Secure electronic signature technology uses algorithms and encryption to determine the authenticity of the signature and the signed document. It is available from different providers. When relying on e-signatures, the agent will not be aware of undue influence or duress being applied to the client, whether the client is a victim of fraud or identity theft, or if the client has mental capacity issues. The client could feel that he did not have the opportunity to ask questions or request more information about the document he is signing. The agent must be alert to any red flags that might indicate a lack of consent and must never proceed unless fully satisfied that the client understands his obligations. Even though the relationship may be digital, it will be more important than ever to ensure the agent keeps hard copies of meeting notes and relevant documents in his client file if decisions made or actions taken are challenged in the future. 5.2 Segregated Fund Recommendation. Based on his analysis, the agent brings forward his recommendation and is able to back up his conclusion to the client. The recommendation made to the client must focus on fund specifics. The agent seeks consensus with his client that the recommendation is sound based on information gathered and needs expressed. The client makes the final decision. The next step is to proceed with the application. If the client's decision is contrary to recommendations, the agent should document the client's reasoning and seek input from his manager about proceeding. If a client returns to the agent in the future for a subsequent investment, an assessment of needs and objectives must start afresh. An agent must never assume that previously identified needs can underlie another recommendation. Each investment must be analyzed separately to determine the best available product is brought forth. Every segregated fund recommendation should include the following elements, which are addressed in the next sections: black small square identification of fund and its characteristics, black small square deposit and funding, black small square value of guarantees, black small square contract maturity date, black small square principal risks of recommendation, black small square reset, black small square contract riders, black small square fund taxation, black small square fund sales charge, black small square fund management expense ratio, MER, black small square fund details, black small square fund penalties. 5.2.1 Identification of fund and its characteristics. The recommendation will identify the insurer that provides the fund, e.g. XYZ Life, and how the fund is invested, e.g. equity, income, bond or other. The agent ensures that the investor understands that he is investing in a pooled investment concentrated as per its type, i.e. stocks, bonds or other, and how returns in the fund are achieved, i.e. capital gains, dividends and or interest. Like must be compared to like in the recommendation, i.e. a balanced income fund to another balanced income fund. If two different types, i.e. a balanced income fund and a balanced growth fund, are recommended, the rationale must be provided for each type. 5.2.2 Deposit and funding. The investor must reveal how much he intends to deposit to the contract, or how he proposes to fund the contract. A minimum is specified for each fund for both lump sum deposits, which include transfers, and periodic deposits. Some insurers also have a maximum amount permitted for the premium. The agent follows the client's lead in regard to the sum being invested, and should not push for more than what has been deemed appropriate through the needs analysis. The first-time client may need to develop a comfort level with the agent and the product before making a larger financial commitment. The premium is allocated to fund units at their net asset value, NAV, on the valuation day that applies to the lump sum or periodic deposit. The number of units received may not be the same across all recommendations, since the number depends on the NAV per unit of each fund. Receiving more or less units of one fund over another is not an indicator of fund quality or performance. The NAV per unit of a fund forms a benchmark against which future performance is monitored. It is essential that products with similar characteristics be compared in the recommendation. When different elements enter into the comparison, they must be stressed as a differentiator. The following example shows how the same amount of deposit results in the investor receiving a different number of units. Example: lump sum deposit, $10,000 fund type, balanced income. There are other potential differentiators between the funds to form a further basis for comparison, and they will be addressed later on in the chapter. 5.2.2.1 Lump Sum Deposit. A lump sum deposit is a one-time deposit that may or may not be accompanied by subsequent periodic deposits. If there are no subsequent periodic deposits, the maturity guarantee of the contract is based only on the single sum deposited. Thus, if the investor has a 10-year time horizon for an investment, it is appropriate to recommend a lump sum deposit to take full advantage of the guarantee if funds are readily available. The investor needs to satisfy the minimum deposit stated for the fund. The sum for deposit is received via a personal check from the client or a transfer from another financial institution or pension plan. 5.2.2.2 Transfers. A transfer of money is initiated by the firm that will be receiving the money when funds are being transferred from one institution to another. Relevant details are needed from the client, including the name of the organization or company from which the money will be transferred, an account number, and contact details. An investment statement provided by the client can be very helpful for obtaining accurate information. If a registered account is the source of transferred money, then the contract is set up as another registered account to continue its tax deferral. The same is true for locked-in accounts. A transfer from a locked-in account must go to another locked-in account. Non-registered funds can be transferred into a registered retirement savings plan, RRSP, account or a tax-free savings account, TFSA, and will be a contribution for the year. Sufficient contribution room has to be available for the amount being transferred. If contribution room is exceeded, tax penalties will apply. 5.2.2.3 Periodic deposits. Deposits made on an ongoing basis must meet the minimum requirements set by the fund manager. The cash flow statement for the client, described in the previous chapter, indicates whether the sum he proposes to invest is appropriate and manageable. As with lump sums, periodic deposits can be made to both a non-registered contract and an RRSP contract and TFSA contract. Deposits received throughout a year are RRSP/TFSA contributions for which the investor has to have available contribution room. As seen previously, periodic deposits may create a series of maturity dates and maturity guarantees, one guarantee for each deposit or group of deposits. A client may invest to align his needs with the maturity dates of his deposits. This would be true if an investor wanted to receive maturity proceeds for each year he is retired between ages 60 and 65, at which time his pension would begin. However, if long-term investment growth is the reason for the investment, the multiple maturity dates of the deposit-based contract may not be significant to the investor. Example: Chris has a segregated fund contract set up on the basis of periodic deposits that provides a 75%/75% maturity and death benefit guarantee. At the end of each month for a year, he deposits $250 to the contract. Therefore, each of the 12 deposits is guaranteed at $187.50, $250 times 75%, on each of its 12 maturity dates. Chris's time horizon should correspond to the series of maturity dates. Since the net asset value per unit rises and falls, each deposit may acquire a different number of units. 5.2.3 Value of guarantees. The agent may wish to recommend a set of guarantees for each of the maturity guarantee and death benefit guarantee based on what he has learned about the client, including the client's tolerance for risk. Some clients may agree to invest in relatively higher risk equity funds because they know that the principal sum invested is protected by the two guarantees. Once the choice is made, an actual dollar value of guarantees can be ascertained on the basis of the financial commitment the investor makes or will be making. The agent may also wish to point out that guarantees apply at the rate offered by the recommended fund, either 75% or 100%. If a switch is made from one fund to another during the contract, the guarantee may change if the new fund has a different rate for its guarantees. 5.2.3.1 Maturity Guarantee. The maturity guarantee is automatically provided in all segregated fund contracts as 75% or 100% of deposits at maturity. It should be reiterated to the investor that deposits are guaranteed to the percentage selected for maturity. If the market value of the account is greater than the guarantee due to fund performance, the investor receives the market value. The investor loses the benefit of the maturity guarantee if he surrenders the contract before its maturity date. He also will find that the guarantee is adjusted if a withdrawal is made. The percentage of guarantee, i.e., 75%, remains the same after a withdrawal, but it is based on the new, lower balance. The agent who recommends a fund with one guarantee or the other has to be able to substantiate the decision and compare the effect of a lower or higher MER, in addition to other fund attributes, to make a thorough analysis for the client's benefit. The agent calculates the value of the guarantee and informs the investor of the sum that could be obtained as a result of the guarantee to reinforce this benefit of the segregated fund contract. The agent will also want to stress to the investor that, while the maturity guarantee protects the investor against poor performance, the upside for growth is unlimited. Some funds have higher potential for growth than others. This is related to their risk, and an assessment of risk is detailed in the information folder and fund facts for each fund. 5.2.3.2 Death Benefit Guarantee. Just like the maturity guarantee, the death benefit guarantee is an automatic part of the contract and is a feature of all segregated funds. The agent may feel strongly about which guarantee, 75% or 100%, the investor should have, and this forms part of his recommendation. This guarantee can have great value in the peace of mind it brings to those whose health is impaired at the time the contract is taken out, or to those who are older. Segregated Funds and Annuities Chapter 5 Segregated Fund and Annuity Recommendation 172. 5.2 For contract maturity date. The minimum maturity date is 10 years from the deposit date, and this date should be stated to the client in actual time, i.e. the month, day, and year for maturity based on an initial deposit. The client should also be shown the relationship between a higher guarantee or guarantees and an extended maturity date. Some segregated funds that offer 100% guarantees require a 15-year period to maturity. 5.2.5 Principal risks of segregated funds. The risks of segregated fund investing are expressed in a warning that appears on the cover or face page of a contract that states in bold type: any amount that is allocated to a segregated fund is invested at the risk of the contract holder and may increase or decrease in value. 30. Thus, the investor is alerted to a possible danger. How does the risk arise? Fundamentally, the risk of a segregated fund results from how the fund invests the deposits it receives from investors. As we have seen, each fund is highly diversified within its category. Each investment within each fund has its own individual risk. The risk of individual investments is averaged out, that is, diversified, to produce the overall risk for the fund itself. Fund risk is plotted on a scale with 6 classifications: very low, low, low to moderate, moderate, moderate to high, and high. Even those funds at the bottom of the risk scale will go up and down in value because of changes in interest rates, economic conditions, and business markets linked with that category of funds. Funds are also subject to specific risks based on their type. For instance, a bond fund is highly susceptible to interest rate risk but has little market risk. An equity fund, on the other hand, has higher market risk and equity risk and low interest rate risk. In developing a recommendation, the agent should take into consideration: black small square the risk assessment of each recommended fund. Black small square the forms of risk associated with the recommended products, e.g. exposure to equity risk and inflation risk. Black small square the risk tolerance of the investor. 5.2.6 Reset. The reset feature allows the investor in a segregated fund to lock in, at specified intervals, example, once a year, increases in the market value of the investment. If market value has declined at a reset date, then the reset feature is not utilized. Not all segregated funds offer reset. A recommendation that includes a fund that provides reset, and one that does not must show the cost of reset. That cost may be apparent through a higher management expense ratio, MER. There may be other aspects of reset that need to be compared between recommendations, such as number of resets permitted in a year, or whether reset is automatic or on client instruction. The recommendation needs to show the client how reset affects the maturity date, maturity guarantee, and death benefit guarantee of the contract. Concrete examples should be provided of the effect of a hypothetical reset on the actual deposit amount and date. Example: Nasser's agent, Farah, recommends a segregated fund contract that will have a 10-year maturity date from April 23, 2020. Nasser has a $5,000 premium available and wants a 75% per 75% guarantee structure. The average rate of return on the recommended fund is 5.02% annually over the past 10 years. The maturity date of his contract will be April 23, 2030, 1 month after his 65th birthday. The cash paid out then will help him delay both his Canada Pension Plan, CPP, or Quebec Pension Plan, QPP, and Old Age Security, OAS, benefits, in order to receive the deferral bonus on both. The contract would have an automatic reset every 2 years on its anniversary date. The first reset would be April 23, 2022. This locks in growth, however, the maturity date of the contract would advance to April 23, 2032. Based on this addition of 2 years to the initial maturity date, Nasser will have to begin his government retirement benefits sooner. This means they will be paid at a lower rate. Considering that resets will be automatic, Nasser and Farah should estimate before he enters into the contract whether he is better to take the resets and extend the contract or consider another fund with a 10-year term to maturity for which resets are voluntary rather than automatic. 5.2.7 Contract riders. The recommendation must address whether an income rider should be added to the contract. If an income rider is added in the form of a guaranteed minimum withdrawal benefit, GMWB, or guaranteed lifetime withdrawal benefit, GLWB, the characteristics of the rider have to be thoroughly described. These riders are not widely available, so comparisons between providers or products may be difficult to make. This should also be pointed out to the investor. 5.2.8 Fund taxation. Taxation of the fund will depend on whether the contract is set up as a registered or non-registered account. Taxation rules are predetermined by income tax legislation, so no point of recommendation can usually be made on this basis. As a reminder, black small square deposits to a registered contract will generate a contribution if the contract is an RRSP or TFSA. Black small square RRSP contributions are tax deductible. Black small square taxable allocations of the returns generated by the fund will be declared and will increase the adjusted cost base, ACB, when the account is not registered. Black small square withdrawals are taxed very differently depending on whether the account is registered or not. The agent may point out the primary form of return earned by the recommended investment, e.g., interest, and compare tax advantages of receiving allocations of capital gains or dividends over interest when the account is not registered. Allocations and taxation were reviewed at length in Chapter 2. 5.2.9 Fund sales charge. The sales charge or load is specified by the fund as a front-end load, FEL, a deferred sales charge, DSC, or no load. It is paid by the investor. The cost of an FEL can be calculated by the agent for the investor. It is charged once and reduces the sum being invested. Example: Marc proposes to invest $10,000 in the segregated fund recommended by his agent. It has a 5% front-end sales load. Marc's investment is reduced by $500, $10,000 times 5%, so that his initial investment becomes $9,500. The agent can also illustrate the DSC in dollar terms based on a potential withdrawal amount and the fair market value of the fund. A DSC is charged to every withdrawal according to the DSC schedule for the fund. DSC redemption schedules for mutual fund sales made prior to the ban will be allowed to run their course in Ontario. This means DSC charges could apply up until 2028 or 2029. The recommendation for sales charge is a test of advisor ethics since this fee is a commission the agent receives. However, the agent must recommend the fund or funds with the best set of characteristics based on the investor profile. The sales charge is one aspect of this set. May 2, 10 Fund Management Expense Ratio, MER. The management fee covers management and operating expenses and taxes. Trailing commissions are paid from the management fee. The amount charged as a trailing commission is clearly disclosed in the fund facts for each fund that all potential investors receive. The management expense ratio, MER, of a fund is the percentage of expenses relative to the average value of its assets. MER is not based on performance and it is charged regardless of performance. MERs vary between funds and have a financial impact because they reduce the return on investment. The higher the MER, the greater the reduction in return to the investor. Fund performance is reported net of MER and returns received net of MER. In other words, if a fund has a reported return of 4.2% and an MER of 2.8%, the real return on the fund is 7%, 4.2% plus 2.8%. However, the investor earns 4.2%. May 2, 11 Fund Details. It is an agent's responsibility to discuss and explain the contents of the information folder including fund facts to the investor. Point 31. The information folder and fund facts provide important details about each fund. Fund facts are particularly useful because they are individual outlines of each fund. Their information is provided in such a way to facilitate comparison between funds. They are brief summaries of the many details each fund entails and written to be easily understood. 5.2.11.1 Delivery of Fund Facts. Fund facts are part of the information folder and are delivered to a prospective investor before the application for the contract is signed. They can be delivered in person or electronically via email or through an online site. The client must acknowledge that he has received the information folder in writing or in conversation with the agent. Point 32. Providing fund facts is mandatory as part of the disclosure process that accompanies a sale. 5.2.11.2 Delivery of Financial Statements. The financial statements show selected key financial information about a fund and are intended to help the client understand the fund's financial performance for up to 5 years, depending on the fund's inception date. They are not provided with the information folder. Clients may submit their request for financial statements to the agent or directly to the insurer providing the fund. All funds release annual audited financial statements and semi-annual unaudited financial statements. Clients with a more sophisticated understanding of investing may appreciate the additional level of detail provided in the financial statements. 5.2.11.3 Total Value of Fund. This dollar figure, shown in the fund facts for the fund, reveals how much is invested in the fund. It is relevant because it is the figure on which the MER is based. Funds with a higher total value can potentially offer a lower MER. This benefits the investor since the MER erodes returns. 5.2.11. For fund units, net asset value per unit and market value. The number of units outstanding and the net asset value per unit are shown in fund facts as at the date specified. Market value of units will be the current value, or value as of the most recent valuation date. Over its lifetime, a segregated fund may be divided, in which case unit values will decrease, or consolidated, in which case unit values will increase. Neither event changes the market value of the fund. This data is used for comparison in the recommendation, and is not an indication of the quality of the investment. 5.2.11.5 Date of inception. This is the date on which the fund began operations. Funds with long track records offer more history, by which investors can assess overall fund performance. Funds with longer histories have experienced various market conditions, and have more reliable performance data. Therefore, a client with a lower risk tolerance will appreciate a recommendation that includes a fund with a longer record since he may see historical lows and highs in addition to typical results. 5.2.11.6 Performance data. Performance data is always historical, what has happened over a specified period of time. It may be useful to compare funds, but must never be used to predict what will happen in the future. Moreover, many requirements must be satisfied for performance data to be included in advertisements for funds, and it is essential that an agent not revise this data in any way. Performance is stated as an average return and year-by-year return. Black small square. The average return states how much a $1,000 investment, with the most basic guarantee, 75% maturity/75% death benefit, would be worth, and its annual average return as a percentage for the years shown. Black small square. Year-by-year returns show the fund's annual performance in a chart format. It also states the number of years of positive performance and negative performance. For example, the fund was up in value for 6 years and down in value for 4 years. Where a segregated fund invests in real estate, the purchase and sale of real estate in the fund is described for the previous 5 years. Funds with a history of less than 1 year do not report performance data. 5.2.11.7 Fund Manager. Some performance credit or blame can be assigned to the manager of the fund. The fund manager appears on the fund facts, although the document does not show how long the same manager has been in place. If a fund shows a track record of good long-term performance, but the manager has only been with the fund for the last year, it may be wise to question whether the results will hold up. Likewise, if results align with management tenure, good results over the 5 years with the same manager, it may be fair to conclude that the manager has some impact on results. Finally, if one manager seems to have a record of performance across funds, that data may be important in the decision-making process because that manager may be partially responsible for fund results. Fund managers are regularly reviewed and can be changed if they do not meet expectations of the insurer. 5.2.11.8 Portfolio Turnover Rate. The portfolio turnover rate is expressed as a percentage of the fund's holdings that have been replaced during the previous year. The turnover rate is related to the MER because high turnover translates into higher expenses due to buying and selling costs. A low turnover indicates a buy and hold investment philosophy, and correspondingly lower costs for trading. A lower MER can improve investor returns. May 2, 12 Fund Penalties. The recommendation for a segregated fund investment should be accompanied with a reminder of the long-term nature of the investment, regardless of which fund or funds are selected. Fund penalties should be pointed out and reference made to how they will be calculated, but should not be a basis for comparison since the agent does not want to imply approval to withdraw from the fund or surrender the investment prematurely. Both activities should be discouraged. Some charges or penalties include black small square account closing charge, black small square frequent switching charge, black small square fees to set up registered accounts, black small square short-term trading fee, black small square unscheduled withdrawal or switch fee. 5.3 Finding for an annuity. An investor seeking income in a relatively straightforward product is a likely candidate for a payout annuity. Those looking for a very conservative non-income paying investment without the limitations of segregated funds, such as the 10-year term to maturity, sales charges and annual MER, will be potential candidates for an accumulation annuity. As is the case for segregated funds, the agent must satisfy the principle of suitability for annuities. He must analyze benefits and limitations of an annuity investment in view of his client's needs, and make a thorough comparison of annuities suitable for those needs. The agent's analysis leads to a recommendation that he backs up to the client in the reason why letter. Documentation of the recommendation is key in order to show alternatives presented, if ever questioned in the future. The client agrees that the recommendation is sound based on information gathered and the needs he expressed and makes the final decision. This, too, should be recorded in agent notes. The final step is to proceed with the application. 5.3.1 Annuity Analysis. In Chapter 3, the following questions were posed in assessing an annuity to understand its features, benefits and limitations. Black small square is the annuity being created to pay income or for savings. Black small square how many lives will be covered. Black small square will the annuity payments be made for a period of time or life. Black small square when will income begin. Black small square will income be a level payment or variable. Black small square how will the contract be funded. Black small square which form of taxation will apply. Now for the annuity recommendation, these questions become, black small square does the client need income or savings? Black small square is it sufficient for the client to be covered or should it be the client and his spouse? Black small square is the income need temporary or lifelong? Black small square when does the client need income to begin? Black small square does the client need level income that he can count on or is variable income better? Black small square how will the client fund the contract? Black small square what will be the tax impact on the client? The agent has many products to analyze to look for appropriate answers to these questions and formulate a suitable recommendation. It may not be possible to arrive at a recommendation that ticks all boxes on the client's list of needs and circumstances. In this situation, the agent can proceed with the best available recommendation while pointing out its advantages and shortfalls. An agent's ethics may be tested if the most suitable recommendation means the loss of the sale because the agent cannot provide the best annuity for the client, or the annuity product itself is not the best choice. Regardless, the only course of action available to the agent is to be honest and explain to the client the rationale for the recommendation. 5.3.1.1 Current offerings. The agent needs to keep himself apprised of new product introductions and innovations. It is never appropriate to rely on former decisions or only on knowledge of a stable of long-standing products. Every decision should be based on a review of what is currently available, which may include the new and old. 5.3.2 Supporting the annuity recommendation. Once the agent has determined which investment factors are most important to client needs, based on the investor profile, he may find that the characteristics of annuities make them the preferred choice, rather than segregated funds. For instance, if income is a prioritized need, then an annuity may be the best recommendation. It may also be suitable to acquire both a segregated fund to protect some of the investor's capital while enabling growth, and an annuity for its income stream. Most importantly, the agent must have a sound basis for his annuity recommendation that is a result of client needs weighed against product features. Limitations need to be reviewed. All factors relevant to the decision should be presented so the client understands the reasons the annuity is the best investment considering his objectives. 5.4 Annuity recommendation. A logical starting point for the recommendation is the type of annuity best suited to the client. Once the purpose of the annuity has been determined, the agent and client must determine how the deposit will be made, when payments will begin, the payment schedule, whether payments will be level or variable, and the guarantee period best suited to manage the risk of the investment. Every annuity recommendation should include the following elements, which are addressed in the next sections. Black small square type of annuity and its characteristics. Black small square timing of payments. Segregated funds and annuities Chapter 5 Segregated fund and annuity recommendation 182. Black small square annuity rate. Black small square value of guarantees. Black small square principal risks of annuity recommendation. Black small square annuity penalties. 5.4.1 Type of annuity and its characteristics. There are two fundamental types of annuities, payout or accumulation. A payout annuity is recommended when income is indicated. The agent must also recommend how long the income should be paid, either a term or life. Black small square term requires a choice of time periods, i.e. 10 years, 20 years or to a specified age, such as age 90. Black small square life requires a recommendation of lifelong income for the client alone, leading to a personal contract, or the client and his spouse, leading to a joint and last survivor contract. A prescribed annuity, in which the same amount of interest and capital is received by the annuitant in every payment, is generally considered preferable to an annuity taxed by the accrual method. Structuring the annuity so that it will benefit from being prescribed can also be incorporated into the recommendation. The agent has to be aware of requirements for payout annuities funded by a transfer from a registered or locked-in account, such as age limits and minimum withdrawals. These requirements take precedence over client needs and wants and must be fulfilled. An accumulation annuity is recommended when the analysis indicates the suitability of an investment return approach. The agent also recommends a suitable maturity date for the annuity, based on the time horizon of the investor. 5.4.1.1 Minimum and Maximum Investment. A minimum investment for each type of annuity is stated by the insurer offering the product. A recommendation cannot be based on less than this amount. A maximum may also be specified by the insurer. The client must have funds available in cash or by transfer. 5.4.1.2 Maturity date. A maturity date applies to both a term annuity and an accumulation annuity. Determining the length of time until the maturity date depends on the income need to be satisfied by the term annuity and the time horizon for the accumulation annuity. If the accumulation annuity is not being used to save for a specific event and therefore does not have a time horizon, the agent determines the reason for acquiring the annuity and matches a maturity date accordingly. If there is a need for higher income, a shorter term to maturity for the term annuity should be recommended since payments will be higher when they are made over a shorter period of time. If the need is to create a stopgap source of income, also called income bridging, for those who have stopped working and are not yet entitled to full retirement benefits, then the length of the term annuity should be aligned with the period of time between when the individual stops work and starts receiving his pension. 5.4.2 Timing of payments. Payments from a payout annuity may be recommended to begin immediately or at a later date, known as a deferred annuity, based on the client's need for income. 5.4.2.1 Immediate payments. An immediate annuity, in which payments begin on the next scheduled payment date, could be recommended to an investor who has funds available and an immediate need for an income stream. If a registered retirement savings plan, RRSP, at maturity is being converted to an annuity, annuity payments must begin in the year following. They cannot be deferred to a later date. 5.4.2.2 Deferred payments. Deferred payments are suitable to recommend to an investor who wants to accumulate deposits in the contract prior to starting income, or who wishes income to begin at a future date. The future date may be an obvious one, i.e. when retirement begins, or another time as determined in the investor profile. 5.4.3 Annuity rate. The annuity rate offered by the insurer for the recommended annuity will be in force for the duration of the annuity once the contract is finalized for an immediate annuity or payments begin for a deferred annuity. Annuity rates vary between insurers, and agents who have the ability to shop around for best rates can incorporate those rates in their recommendation. There are many annuity calculators available on the internet for the do-it-yourself investor that can show some very advantageous annuity rates. The agent's recommendation is a combination of benefits for the investor that includes the offered annuity rate, but is not based on the annuity rate alone. Annuity rates used by insurers are different for fixed income annuities and variable income annuities. 5.4.3.1 Fixed income annuity. A fixed income annuity in which each payment is equal is best suited to an investor without the risk tolerance needed for a variable income. An investor who wants or needs income security is well served by a fixed rate of payment. 5.4.3.2 Variable income annuity. An investor who has risk tolerance for the ups and downs of the stock and bond markets may prefer a variable income annuity over one that provides a fixed income. His payments rise with a rising market or fall with a declining market. A recommendation for a variable income annuity should take the age of the investor into account, since losses incurred at an older age are more difficult to make up than when a person is younger. An indexed annuity sees payments increase based on the schedule provided in the contract, in step with increases in the cost of living. There is a significant price premium for adding the indexing feature when purchasing an annuity over a longer term, and a recommendation would properly show the cost for an annuity that is not indexed in addition to the indexed annuity. 5.4 Value of guarantees. Guarantees customize an annuity contract to suit the needs of the policy owner. They increase the cost of the annuity for the policy owner and consequently decrease the amount the annuitant receives. On the other hand, they provide the policyholder with the assurance that a minimum amount will be paid to the beneficiary in the event the annuitant dies before the end of the guaranteed payment period. 5.4.1 Life Annuity Guarantees. The guarantee period of a life annuity minimizes investment risk for the investor. He can be assured that, in the event the annuitant dies during the guarantee period, a sum representing the balance of the guarantee will be paid to a beneficiary. Therefore, the guarantee ensures a minimum return from the investment during the guarantee period. Death of the annuitant after the end of the guarantee period does not generate a payment to the beneficiary. The recommendation can address risk tolerance by proposing a longer guarantee period for a client with low risk tolerance. The longer guarantee period produces a lower income payment to the annuitant. This must be balanced against the likelihood of the beneficiary receiving a payment when the annuitant dies. A higher risk tolerance may indicate a shorter guarantee period. The shorter guarantee period rewards the annuitant by making higher payments, but puts the beneficiary at risk since he may receive nothing if death of the annuitant occurs after the guarantee period ends. Usually the need of the annuitant for income is considered before the beneficiary's eventual need for proceeds from the contract. Age also enters the equation for the length of the guarantee period. Recommending a 20-year guarantee period for a life annuity acquired at age 80 may be overly expensive and optimistic. 5.4.2 Return of Premium Guarantee. A return of premium guarantee, added as a rider to the contract, also is a risk management technique. It pays the beneficiary the full deposit to the contract if the annuitant dies before the first payment. Recommending the rider is appropriate for those who have a low risk tolerance, when a deferred annuity is recommended, when the annuitant is in poor health, or to ensure return of principal invested to the estate. 5.4.5 Principal risks of annuity recommendation. The principal risk of an annuity recommendation is an annuity rate that improves in the future due to an increase in interest rates. The higher rate will be unavailable to annuitants whose contracts are already set, and therefore, they will earn less than they would have received if they had had the higher rate. This risk may be managed by recommending that a series of annuity contracts be acquired over a period of several years. This approach is called laddering. Each annuity has its own annuity rate, but there is no guarantee that interest rates will rise. When interest rates rise, they tend to do so very gradually. To risk laddering in the hope of rising rates, annuity purchases would have to be stretched over a number of years. Inflation risk is a significant risk to annuity investors. It is related to the issue of the set annuity rate, and also the fixed payment rate. Inflation risk can be managed by an indexed annuity. The investor must decide whether its additional cost is worthwhile. Finally, an annuity allows little or no flexibility for the investor. He loses control of his capital in exchange for the security of the income stream. This may be suitable for some investors, yet not others. 5.4.6 Annuity penalties. An annuity is a commitment for a period of time or life. Although some annuities may permit a withdrawal or surrender, others do not. Payout annuities cannot be surrendered. However, accumulation annuities are generally redeemable, although penalties may apply. A term certain annuity may be surrendered upon approval of the insurer. The ability to withdraw funds from the contract or surrender it prematurely should not be a basis for comparison or form part of the recommendation to buy. The recommendation must emphasize the commitment made by the investor and the guarantee made by the insurer to the investor. Chapter 6 Segregated Fund Contract. Competency components. Black small square analyze the available products that meet the client's needs, Black small square implement a recommendation adapted to the client's needs and situation. Black small square provide customer service during the validity period of the coverage. Competency subcomponents. Black small square analyze the advantages of segregated funds in comparison to other types of investment in regards to the client's needs. Black small square confirm the requirements that must be met to implement the recommendation. Black small square validate the appropriateness of contract amendment, renewal and termination application in regards to the client's situation. Black small square inform the claimant of the claims process.